So hello dark traders, welcome to Darkwave Trading, and as always my name is Darksins. Alright, I always begin by asking you a very simple question, which is why are you here? Why are you doing this? Hoping that you do have the right reasons. Then I normally proceed to show you this disclaimer and to ask you to take your time and go through it, please. Alright, now today I want us to focus on risk management. Alright, so we're going to start, and I hope I'm going to explain it in a way that you're going to understand, because it's very, very important, right? So I'm going to show you the steps to risk management. You're going to start by the smaller picture and then the bigger picture later, and then we combine both of them. So step number one for risk management is you have to know your risk. You have to know what you stand to lose if it goes south against your expectations. For example, you are buying, right? For example, you are buying and then the market starts to sell. You have to know what you stand to lose when the market goes against you, right? Your risk is something that you're supposed to be comfortable losing, right? You cannot risk your entire portfolio because you cannot be comfortable losing your entire portfolio, all right? And in normal occasions, the appropriate risk is normally calculated by taking your account size dividing by 100, resulting to 1 or 2% per trade. So if you have $100 account, your risk per trade is supposed to be $1 for every single trade. All right. If you have a $10,000 account, you divide that by 100, you get that your risk is supposed to be $100 per trade, right? Now, after the knowing your risk, number two is normally know your reward, right? And you have to know when you risk that $100, what do you stand to gain? All right. Reward is what you stand to gain if the trade is successful. If you are buying and the market moves in the side of your direction, that is, it goes higher, what do you stand to gain? All right. And getting the risk reward ratio, you take the reward, you divide by the risk. So if I'm risking $100, expecting $300, right? You divide that, you get a risk reward of 1:3. Realistic risk reward is something like 1:3. We have unrealistic, we have over ambitious risk reward, something like 1:100. You cannot risk $100 expecting $10,000, right? Yes, you cannot do that. You can't do that. Sometimes it happens once in a while. You can do that, but it's not something you can entirely depend on. And then there's I was going to talk or refer to which is the other one. There's over ambitious RL. I've talked about that. Unrealistic risk reward, that is something like 1:negative or 1:0.5, risking $100 to get 0.5, which is $50. That is not realistic. You cannot risk $100 for $50. Now step number 3 is going to be calculate the size of your position, right? And to calculate the size of your position, you need a couple of things. You need to know the currency that you are trading. For example, Euro USD. You have to know the risk, and we have said it's supposed to be 1% of your account. So if you're risking $100 for a 10,000, you're supposed to risk $100 for a $10,000 account. You also have to know the size of your stop loss so that we can be able to calculate the size of your position. Now, for example, you might say that I will risk $100 for a buy. This is the trade you're buying, betting that the market is going to go up. In Euro USD, that is the currency. Expecting $300, that is the reward. You see, the risk is $100, the reward is $300, and you know the currency and what you're trying to do. Now, if my trade goes well, you expect $300. Now, you have to know the size of your stop loss, which is, for example, 10 pips. All right. So that being said, the stop loss removes you from a trade automatically when you make a certain loss. That is the purpose of a stop loss. So immediately you make a loss. If the market goes against you and you make a loss of $100, the market, you'll be removed out of the market immediately, right? For the trade above, for example, this trade where you're risking $100, expecting $300, if the market goes against me by dropping for 10 pips, which is the size of your stop loss, because I'm buying, and remember 10 pips is the size of my stop loss, I want to make sure that the trade, the loss I incur is exactly or approximately $100, because that is my risk. All right. Now, to incur the loss I'm comfortable with, you need to execute the right units of a currency, and simply put, you have to use the appropriate lot size. And when we were discussing about terminologies, I did talk about lot sizes, right? And what the lot size do, you see, for the trade above, the approximate lot size ensures that you lose $100 if the trade goes against you, and also it ensures that you earn $300 if the trade goes in your direction, right? You also have the take profit level, which removes you automatically from the market when you make $300. Are we together up to that point? Now, a complete trading position needs the following. Number one, you have to know the entry price. All right, so I'm trying to buy Euro USD at the entry price, for example, something like W. All right, you have to know the stop loss level. Where is your stop loss? Right, before you go executing, these are the kind of things that you need to know. Right, you have to know your take profit level. Say, call it Y. You have to know your lot size, and we have said that the lot size ensures you execute the appropriate amount of units, ensuring that when you lose a certain amount, you're removed out of the market, and when you make a certain amount, you are taken, you lock your profits. All right. Now, so for example, at price X, okay, at price W, for example, at price W, I will buy, or I will execute Z lots. I will buy Z lots, and I will place my stop loss at price X. Then I will set my take profit at level Y. These are the kind of things that you need, and I'm going to show you how we actually use them. Now, let's see how to calculate the appropriate lot size. All right. For this thing, we use position size calculators, right? And I'll show you an example of one. All right. So for example, you see, my analysis or my strategy might give me a position like this, assuming all of these hadn't happened yet. And I think this trade is among the trades. When I was making one of the videos, this trade was actually live, for example. So my strategy told me to buy here, right? To take a long position in Euro USD. And you can see this is my entry position, entry price. This is the profit level and all of that stuff, right? So for example, there where you see here, that is my entry price, and it corresponds to that price, right? And this level here, that is my stop loss level, and that corresponds to that price. And right here, that is where we have my take profit, and it corresponds to that price. See, when you have done your analysis, that is technical plus fundamental and sentiment analysis, giving you a signal, all right, telling you what to do in the market, you have to have all of these things. See, now once we have these details, we normally proceed to, I forgot, you see the price there, right? That is my stop loss in pips, and you can see the size of my stop loss in pips, that is 6.1 pips, right? And right there you can see something called the risk reward ratio, which in this case is 3.64. That is to mean that if I risk $100, I stand to make $364 from that trade. If I risk $10,000, you stand to make $3,640 if it goes well. But if it goes against you, in 6 pips you get taken out of the market, incurring the risk that you had predetermined. All right, now after having those details, we normally go to a position size calculator, which normally looks like this. And you normally start by having the instrument which you're trading, I told you, and this is your accounts the base currency of your account, deposit currency, your stop loss. I've told you will need to know the size of your stop loss in pips, and you have to also know the account balance and the risk. As we said, we're risking 1% of your account. So let's look at this. For example, your account balance is $10,000, right? This is just an example. And if your account balance is $10,000, what risk did we say we normally take? We normally take a 1% risk, right? 1% is if it calculates here, it's supposed to give me money at risk to be $100, right? Now, this instrument we are trading could be Euro USD, could be GBP USD, could be just any pair, right? And from previously, we saw that the size of my stop loss was 6.1 pips, right? It's supposed to be like that. Once you input that information and then you click on calculate, it's supposed to give you something like this. I'm trading instrument Euro USD. My account balance is $10,000. I'm risking 1%, and you see my money at risk is $100. The size of my stop loss is 6.1, so I'm supposed to execute 1.639 lots. All right, and when I execute 1.639 lots, that simply means that if the market goes against me for 6 pips, I'll only lose $100. And one standard lot is equals to 100,000 units. That is why you will multiply this by 100,000, you get 163,934 units. Are we clear on that? Now, you see that is the money at risk, that is your lot size, and that is that. Now, let's combine all these three things together. Number one, you did your analysis and you got all these details. You want to buy Euro USD, the size of your stop loss, and all of that stuff, right? You did calculate the size of your position, and you figured that you're going to have to execute 1.639 lots. And then number three, you get to go to a trading platform where you have something like this, right? In this case, it's going to be a buy limit. I'm going to explain this later. We have buy limits, we have limit orders, and we have market execution, right? There's a couple of them, but for this example, I'm going to use a buy limit. And a buy limit simply says when price gets to a certain point, you get, for example, when price gets to 1.07293, I will automatically be plugged into a buy in Euro USD. It's a buy limit when the market gets to this price. All right, now number one, we got the lots from position size calculator. This is where it goes, right? This is how you execute. You transfer these details in MT5 or MT4. This is MT5 or MT4, right? So, and then number two, the entry price. I've said these are buy limits, so when we get to this price, we get to be tagged in a buy for that currency, right? You just transfer. And then that SL, stop loss, is where you place your stop loss, which simply means when the price gets to because I'm buying, when it gets to 1.07234, I'm going to be removed out of the market automatically, and if that happens, I would have lost $100, right? Then finally we have TP, which simply means take profit. You just transfer these details. Once you do that, you click on a buy, right? You place the order. When it's market execution, that is when we get something like a buy, but for this case, you see it's I took the screenshot when the market was closed, but you can see something like place, right? That is what we simply do. That is how you calculate. That is how you calculate these things, right? So I would like to go over this again fast, but let me do it pretty fast so that you can understand. Finally, number one, in risk management, you have to know your risk, what you stand to lose if it goes against your expectation. For example, $100, it should be something you're comfortable losing, and then it's supposed to be 1% of your account. Number two, you need to know your reward. Then you have, that is what you stand to gain if it is successful, and you divide risk reward by risk to get the risk reward. We have a realistic RR, which is 1:3, and we can also have unrealistic or over ambitious RR, like 1:100, and unrealistic RR, like 1 risking $100 for $50. After that, you need to calculate the size of your position, and for that you need to know the currency you're trading, the percentage of your account you're risking, and the size of your stop loss. For example, you're buying Euro USD expecting $300 and the size of your stop loss is 10 pips. You know that details. Stop loss removes you from the market when you make a certain loss, right? For the trade above, I've explained about that. To incur the loss you're comfortable with, you need to execute the right units of a currency and simply put the appropriate lot size. And for that, we normally use a position size calculator. A complete trading position needs the following: it needs an enterprise stop level, it needs the take profit level, and lot size. I've talked about that. Now, for example, I told you now, I've explained how to do that. We use a position size calculator, and trading position looks like that. We have the entry, that price, we have the stop level, that price, we have the TP level, that price, and then we have the size of your stop loss in pips, and when you have your risk reward, which is 3.64. Now we have a position size calculator. You enter the instrument, your account balance, the risk in percentage, the size of your stop loss, and it will calculate and tell you the money at risk and the lots you need to execute all of that, and gives you something like this. Tells you your money at risk is that, and the size of the stop loss you need to use is that. After that, you now combine the three things: your trading position, the lot size that you've calculated, and you go to MT5 or MT4 or C trader, wherever you're doing your executions, right? And then you start transferring these things one by one, and then finally you do that. This is the first phase. This is the smaller picture. You have to do this for every single trade that you take. Yes, for every single trade that you take, you need to be doing this again and again and again. All right, trust you me. Then we're going to discuss about how all of these factors in the bigger picture. Yeah, I hope I've not confused you, and I hope we'll do and have more examples, but that could help. I know that.